On October 16th, 1973, Saudi oil minister Ahmed Zaki Yamani walked into the Sheraton Hotel in Kuwait City and told 6 Persian Gulf oil ministers they were about to change the price of oil themselves. Not ask, not negotiate, set it. Not next quarter, not after consultation with the oil companies. Now, within hours, the posted price of crude had jumped from $3 to $5. Within 3 months, it would hit nearly $12, and within a year, the American economy, the largest on earth, would be on its knees. Gas lines stretching 5 miles, fistfights at filling stations, truckers shooting at each other on Pennsylvania highways, the stock market losing half its value. That was 1973. Today, the Strait of Hormuz, the choke point that carries 1 out of every 5 barrels of oil consumed on Earth, is shut down for the first time in modern history. Not threatened. Shut. Iranian missiles are hitting tankers. Insurance companies have pulled coverage, and oil is climbing past $80 a barrel with no ceiling in sight. The question you're asking right now is the same question Americans asked in 73, in 79, in 90, and in 2022. When energy becomes a weapon, what do you actually own that holds its value? Before we go further, nothing in this video is financial advice. This channel examines history. What you do with it is your decision. Do your own research. We are historians here, not brokers. The official story of every energy crisis is the same. It is temporary. The government has it under control. Prices will stabilize. History tells a completely different story. On November 7th, 1973, Richard Nixon went on television and announced Project Independence. America would be energy self-sufficient by the end of the decade. It was a lie before the words left his mouth. American oil imports actually increased every year after that speech. His Emergency Petroleum Allocation Act created a 2-tier price system that capped domestic oil at roughly $5 a barrel, while world markets hit 12 to 17. The result was exactly what any economist would predict. Domestic producers had no incentive to drill. Refiners could not get crude. The government created the shortage it claimed to be solving. Temporary, under control, stabilizing. Gasoline rationing arrived anyway. By the last week of February 1974, 1 in 5 American gas stations had no fuel at all. The American Automobile Association confirmed the numbers. New Jersey imposed the odd, even license plate system. Odd plates on odd-numbered days, even plates on even days. Oregon, Massachusetts, and half a dozen other states followed. Drivers waited in lines stretching for miles. In Maryland, the lines hit 5 miles. Nixon signed the 55 mph national speed limit and asked gas stations to close on weekends. 90% complied, which paradoxically created even longer weekday lines. In December of '73, striking truckers in Pennsylvania and Ohio opened fire on drivers who refused to join the strike. In Arkansas, trucks were firebombed. This was America, not a war zone, a gas shortage. Now, the assets. Here is what the research shows across 5 energy crises spanning 7 decades. Suez in 1956, the Arab embargo in '73, the Iranian Revolution in '79, the Gulf War in 1990, and the Russia-Ukraine shock in 2022. The pattern is consistent, and it contradicts nearly everything the financial press tells you during the first week of a crisis. Energy stocks are not automatic winners. This is the single most important finding, and it will surprise you. During the 1973 embargo, the one where oil quadrupled, a basket of the 8 largest American oil companies fell 35%. Exxon posted a record $3 billion in profit that year. Texaco's profits doubled. It did not matter. The bear market overwhelmed the commodity tailwind. Investors sold everything, including the companies making the most money. Energy stocks only dominated over the full decade, returning more than 200% from 1970 to 1980 against roughly 50% for the broader market. The lesson is about time horizon. If you bought oil stocks the week the embargo started, you lost money for a year and a half. If you held for 7 years, you made a fortune. In 2022, the pattern flipped. Energy was the only positive sector in the entire market, up nearly 60%, while the broad index fell almost 20%. Every single one of the 10 best performing stocks in the index was an energy company. ExxonMobil posted the largest annual profit of any Western oil company in history, $55 billion. Shell earned its highest profit in 115 years of existence. While Occidental Petroleum surged over 100% after Warren Buffett's Berkshire Hathaway quietly accumulated a $12 billion position. The commodity trading houses made even more. Vitol earned $15 billion. Citadel earned a record $16 billion in a single year, with roughly half from commodity trades. But this only worked because the broader market was not in a deep structural bear. In a true crash, everything sells. In a correction, the strongest sector leads. Gold requires inflation and easy money to surge. It does not just need a crisis. In the 1970s, gold went from $65 to $850, a gain that still staggers. But that decade was a perfect storm. Inflation hit nearly 15%. The Federal Reserve was behind the curve for years. The dollar was so weak that the Treasury was issuing bonds denominated in Swiss francs, nicknamed Carter bonds, because foreign investors would not hold dollar debt. The Soviet invasion of Afghanistan on Christmas Day 1979 piled geopolitical fear on top of monetary chaos. Gold peaked at $850 on January 21st, 1980, the day before Paul Volcker's rate hikes began to bite. Then it fell for 20 years. During the 1990 Gulf War, a genuine oil shock, gold barely moved. The crisis was short, inflation stayed low, and the Fed was not printing. In 2022, gold ended the year flat despite war in Europe and 9% inflation because the Fed was raising rates aggressively and the dollar was surging to its highest level in 20 years. Gold is not a crisis hedge. It is an inflation plus easy money hedge. The distinction matters right now because the Fed's next move will determine whether gold at $2,400 is the beginning of a run or the top. Government bonds failed in every single energy crisis. Everyone. In 73, yields rose. In 79, they exploded to over 15%, the worst sustained bond bear market in modern history. In 2022, it was the worst bond year in 4 decades. Energy crises are inflationary events. Inflation is poison for fixed income. This week, as oil surges past $80 and the Strait of Hormuz stays shut, the 10-year Treasury yield is climbing again. Bonds are not protecting anyone. The counterintuitive winner across 7 decades is not what you expect. It is not oil. It is not gold. It is logistics. The physical infrastructure that moves energy from where it is to where it is needed. During Suez in 1956, oil prices barely moved. Tanker rates exploded 1,400%. Aristotle Onassis, facing bankruptcy with an idle fleet of ships nobody wanted, made $70 million in a single year because his uncontracted tankers were suddenly the most valuable assets in world shipping. $2 million profit per voyage. He went from the edge of ruin to one of the richest men alive in 12 months. His rival Stavros Niarchos profited from the same mechanism with a competing fleet. The crisis did not reward the men who owned oil. It rewarded the men who owned the ships. The mechanism was not the commodity. It was the choke point. Whoever owned the capacity to move oil around the bottleneck owned the crisis. That mechanism is playing out right now. With Hormuz shut and the Red Sea still dangerous from Houthi attacks, every barrel of oil that reaches market has to go around the southern tip of Africa, adding 10 to 14 days per voyage. Shipping rates are spiking. Insurance costs have risen 12-fold. The companies that own tankers, pipelines, and refining capacity outside the conflict zone are repricing in real time. The mechanism has not changed since Onassis. The instrument has. The second strategy that worked was being on the right side of the disruption, not in the commodity itself, but in what the commodity breaks. Japanese automakers understood this better than anyone. After the 73 embargo, American car sales fell from a record 9.7 million units to 7.5 million in a single year. The big three were building land yachts that averaged 13.5 miles per gallon. Pontiac's 455 V8 engine had already been slashed from 310 horsepower to 200 by emissions rules, and now nobody wanted the car it sat in at any horsepower. General Motors, Ford, and Chrysler hemorrhaged market share to Toyota, Honda, and Datsun, whose fuel-efficient cars were suddenly the only vehicles Americans wanted. By 1980, Japan had surpassed Detroit in global automobile production for the first time. Japanese imports went from 9% of the American market in '76 to 21% by 1980. The oil shock did not just move money from one stock to another. It permanently restructured an entire industry. The winners were not oil companies. They were the companies that solved the problem oil created. The third strategy is the one you least expect, and it comes with a brutal warning. Farmland. During the 1970s, farmland values nearly quadrupled. Crop prices doubled and tripled. Soybeans hit nearly $11 a bushel. The government told farmers to plant fence row to fence row. Everyone assumed energy-driven food inflation would last forever. Farmers borrowed against rising land values to buy more land. Then Paul Volcker raised interest rates to 20%. Iowa farmland lost 60% of its value. 300,000 farmers defaulted. The suicide rate among farmers ran 4 times higher than normal through the 1980s. The energy crisis of the 70s created the farm crisis of the 80s. Farmland was not wrong as an asset. It was wrong as a leveraged bet on permanent inflation. The mechanism worked. The leverage killed it. Now, here is what is happening again. The Strait of Hormuz carries roughly 20 million barrels of oil every day. 1/5 of everything the world burns. Saudi Arabia, Iraq, the UAE, Kuwait, and Iran all ship through it. Qatar sends roughly 20% of the world's liquefied natural gas through the same narrow channel. There are bypass pipelines, but they carry a fraction of what flows by water. Iraq, Kuwait, and Qatar have no alternative route at all. This is the first time Hormuz has actually been closed. During the Iran-Iraq tanker war in the 1980s, both sides attacked over 400 ships in 7 years, but never disrupted more than 2% of traffic. In 2011 and 2012, Iranian officials threatened to close the strait over sanctions. Markets blinked and forgot within days. In 2019, drone strikes on Saudi Arabia's Abqaiq facility knocked out nearly 6 million barrels a day, the largest single outage in modern oil history, and prices recovered to pre-attack levels within 2 weeks. This time, the strait is not threatened. It is shut. Insurance companies, not navies, enforced the closure. Cheap Iranian drone strikes on tankers triggered protection and indemnity insurers to withdraw coverage entirely. War risk premiums surged 12-fold overnight. A single voyage through the strait now costs $250,000 in insurance alone, if you can get it at all. No insurance means no commercial shipping, regardless of how many warships escort the convoy. Trump has offered naval escorts, echoing Operation Earnest Will from the 80s. But the 80s demonstrated that even with escorts, mines and missiles get through. And in 2026, the problem is not the missiles, it is the underwriters. Over 700 tankers are queued outside the strait, waiting for a resolution that has no timeline. The damage is spreading beyond oil. Qatar Energy, which supplies roughly 20% of the world's liquefied natural gas, has halted production at Ras Laffan after drone strikes on the facility. South Korea has warned it could run out of natural gas in 9 days. Japan holds roughly 150 days of oil reserves, but is far more exposed on gas. India, with only 25 days of crude reserves and half its oil transiting Hormuz, is the most vulnerable major economy on Earth. China has ordered its largest refineries to halt fuel exports. This is not a disruption. This is a restructuring of global energy flows happening in real time. So what does history say you should actually do? 4 things. First, if you own energy stocks, the research says hold through volatility, but do not chase the spike. The 73 precedent shows that the first year of an energy crisis can destroy energy stocks along with everything else. The full cycle returns are where the money is. If this crisis lasts months, not days, energy equities will outperform. But buying into the first week's panic is historically a coin flip. Second, watch the Fed, not the oil price. If the Federal Reserve accommodates the inflation, keeps rates low, and lets prices run, gold will move much higher from here. If it tightens aggressively, the way Volcker did in '79, gold will stall, and bonds will eventually become the trade. The Fed's decision, not the oil price, determines which asset class wins the second half of this crisis. Third, the overlooked trade in every energy shock is the logistics layer. Shipping companies, pipeline operators, refining capacity outside the conflict zone. Onassis got rich not because he owned oil, but because he owned the only way to move it. That mechanism is active right now with both Hormuz and the Red Sea effectively closed. Fourth, do not leverage into farmland or any other real asset on the assumption that energy-driven inflation is permanent. The 1970s, farmers who did that lost everything in the 80s. The mechanism of real assets as inflation hedges is sound. The mechanism of borrowing against them during a crisis is how fortunes die. Here is the insight that 7 decades of energy crises prove, but no government has ever admitted. Every energy shock in the historical record ended the same way. Not when supply returned, but when demand was destroyed. The '73 embargo ended when the global recession it caused cut oil consumption. The '79 crisis ended when Volcker's interest rates crushed the economy. The 2022 spike ended when European industry shut down and China locked down. Governments never solved the supply problem. They waited or engineered a recession severe enough to make the supply problem irrelevant. The question hanging over the Hormuz closure right now is not when the strait reopens. It is how much economic damage the world will accept before demand falls far enough to make the price of oil not matter. Thank you for watching.